Hey traders, welcome to this video. I just thought I'd get everyone up to date on another chart just before we close out the week. As always, if you want to get on board with myself, just check under this video and you can get started. So the DAX, the German DAX, is really a good chart to look at, guys, because this weekly candle we can see we're closing out now is very full-bodied. If we zoom in, you can see the opens down here and the close is very close, if not on the high. Now that shows us that price is pushing hard, and we can start to make a decision on how we want to trade this. So it's likely for risk-averse traders, they're going to start to look short as we run up to, your 16K level. Now, the reason why that is, and I would say just getting on to 16,000 points is probably where you want to start to get short. And the reason being is because of market value. Now, if you're not familiar with what market value is, it's quite simple. If you're selling something in real life, you really want to get the most value for it, don't you? I mean, nobody likes getting ripped off. No one likes getting a terrible deal. Nobody likes buying something and then selling it really for far less than they got it for. So just understand that if you're going to be shorting this, in other words, you borrow contracts and sell them back later effectively, you want market value. And the only place you're going to get market value, or the only agreeable real place we can both say is good for market value, is at previous highs. And that's because that a previous high naturally and inherently is a high price. Now you might say, okay, well, I don't think this is a high price. I think 20,000 points is a high price. Well, yeah, that may be so. And we don't know when we're going to get there, but that would be higher than this high. But all we can actually see on the chart visibly is the highs here. You can only really see what is a high price naturally by looking at the markets. Now, if I zoom out to the monthly, again, that is our only point of reference at this current time for a high price. So when the price gets near to that, we want to get short because we're really looking for something like this, okay? We're looking for the market to pull back, and inevitably it will. So we can look to start to short as we get up to this market value zone. And we don't want to buy now because it's too late. If I take this market value sign here and I just change it to green, let's say, that was good for longs and that had good buy side market value. Add did this. And this is why we trade as pretty much in trends, or we buy dips if you like. We do that because that's the only way to get market value. You shouldn't be buying where there is not a dip, and that is now. I mean, if you're buying where there isn't a dip, you're probably going to get a bad price. Now you need to sell when there is pops, for example, like we've got here. Now that pop will extend and the price will rise higher if we get there, and you're going to start to look short as we come into this area because, again, if you want market value, you want a high price to sell, it's going to come at previous highs. And we can use DCA methods as we do in my academy if the price goes higher, okay, and we can scale into the short side because inevitably the market always will get thumped down. After long rallies up, you will have seen on my profile, my streams for such a long time, the market will get crunched. And it's the same if it falls, it will rise up. It's just naturally how things work. So I hope that helps, guys. If you want further rules like this, go under the video. I'll see you in the next one.